Hi everyone, and thanks for tuning in. As we cross the halfway point of 2025, it is clear that this year has been defined by volatility, driven not just by markets, but by politics and geopolitics. Tariffs, political attacks on the Federal Reserve, and ongoing tensions in the Middle East have all weighed on confidence for both consumers and businesses, and added another dimension to the investment landscape. Interestingly, the US dollar has weakened significantly, down over 11% year to date. While that may seem counterintuitive in a risk-off world, it reflects a growing concern around US exceptionalism and policy direction. Now just taking a look at equity dynamics. Equity markets have told a story of two very different quarters. In Q1, defensives outperformed, emerging markets led developed markets, and tech struggled. But by Q2, sentiment had flipped. The market turned risk on, with tech, particularly the Magnificent Seven, leading the charge. Growth and momentum factors surged, while healthcare and energy, which had performed well early in the year, have lagged. Emerging markets have continued to outperform developed markets year to date, and European equities have been the star outperformers, up over 23% versus just under 6% in the US market. This has been supported by more attractive valuations and positive momentum. Now just taking a look at fund performance. Amid this backdrop, the Northstar Global Flexible Fund returned a solid 6.84% in US dollars in the second quarter of 2025, outperforming the Morningstar peer group by over 1%. Year to date, the fund has delivered 10.64%, outperforming the peer group by over 5% and placing it in the 8th percentile of global flexible peers. Now, this performance has rarely been driven by stock selection. Positive contributors in Q2 include Oracle, ASML, DSV, and an underweight position in Apple. Detractors were mainly in healthcare. Names like Thermo Fisher and Elevance Health face regulatory and tariff pressures, but we remain confident in their long-term outlook. Now just taking a look at the fund positioning. We have remained very nimble in our positioning. Earlier this year in April, when volatility pushed valuations to attractive levels on our buy list, we increased our equity exposure decisively. And this is thanks to our investment process that allows us to track the expected returns of our buy list on a daily basis. Today, the fund remains underweight US and overweight European equities, with notable positions in the UK, Netherlands, Denmark, and Sweden, regions where we see attractive upside potential. Now turning to fixed income. The end of the zero interest rate era means that investors are now being rewarded for taking on risk. With real yields now firmly positive, bonds are once again a compelling asset class. We see them playing a meaningful role as both a source of return and diversification going forward. Now looking ahead, as we expect the tension between policy noise and business cycle dynamics to continue to shape markets for the rest of 2025, we remain very flexible in our mandate, disciplined in our process, and have a valuation-led approach. We believe the fund is well positioned to navigate what comes next and protect shareholder capital. I'd just like to thank you again for your continued support, and for more detail, please visit our website.